Okay, so let's just start with the first subject, quantitative methods. Learning outcome number one, rates and return. So before we begin with, I just wanted to tell you how do you have to study, right? So I have basically prepared these notes for you. We will be using these notes in class. I have went through the entire core, and each and every topic of the core is being covered in these notes. I have made sure. And the reason that I did is because when I was doing my CFA program, what I really felt was the language that is written in the core was quite a complicated for me, at least for me, right? And lots of notations and unnecessary formulas were given, which could be really understood with real life examples, right? So less of real life examples were given in the core. That is what I felt, and more of notations were being used. So that is why I prefer to like prepare my own notes. I'll be teaching through these notes. These are the notes which are prepared by me, and you will be also getting the access to these notes. What you can do is get the printout of it, right? And whenever you are studying, like take the notes along with you, and say suppose we I am discussing some of the topic, or I am doing some of the question, right? And you didn't get that, you have a doubt in that. What you have to do is mark that particular topic or mark that particular question in your PDF, click a picture of it and send me a doubt solving number, and I'll just personally make sure that particular doubt gets resolved to you. Well, reason being that I know for the fact that CFA program is quite a difficult, expensive program for Indian students, right? So we have to make sure we clear that program in a single go, and all three levels are cleared in basically in single go. So yeah, so that is our goal now. So let's just start now. Rates and return. You can take this very first lecture as a broad overview of the entire chapter, learning outcome, or you can take this as a summary of the entire chapter as well. Reason being ki you can take it as a summary because I know for the fact that CFA topics are not that really difficult to understand. It is difficult to remember, right? CFA curriculum is so vast, right? So because if you don't revise each and every topic quite an often, then the topic may get slip off your mind, and it will get problematic when the exams are closer to your right date, the scheduled date, right? So that is why you have to keep on revising the topic. At least 1 or 2 days should be kept in a week just to revise the syllabus that you have already covered, right? So you can view this lecture as a revision of the this chapter as well, and you can take it as a broad overview of the chapter as well. Okay, so this is a mind map. I'll just give you a broad overview of it, and then we are going to cover each and every topic in detail. So rates and return, first learning outcome. This learning outcome have been divided into five major topics. First being the interest rate interpretation, second being the determinants of interest rate, third being the return measurement over time, how do we measure the return, fourth being the portfolio performance measure, how do we measure the portfolio performance, fifth being the other return concepts, right? So let's just start with the first subtopic, which is interest rate interpretation. So how do we interpret the interest rates? Very simple. What is interest rate? Basically, say suppose you go to a bank wherein you deposited 100,000. I'll be using more of an Indian examples because I am from Indian origin, and it will be much more convenient for me to explain the topics. So interest rate. So basically, now you have 100,000 rupee. Now you go into a bank. Say suppose HDFC Bank, you go in. You made a fixed deposit, wherein bank says to you, you will be getting a 7% interest on the 100,000 amount that you have deposited. So you'll be getting basically 7,000 rupee as an interest rate. That 7% is interest rate. Say suppose now you go into a bank, same bank, now you wanted a loan of 100,000 rupee. Bank will charge an interest on it. Say suppose 9%. 9,000 is the interest amount that you have to pay. 9% is interest rate. Now interest rate can be viewed in the CFA curriculum as three broad categories. Three broad names can be given to it. First being the required rate, second being the discount rate, and third being the opportunity cost. And interest rate is generally denoted by small r, right? Small r in your CFA program. Small r notation is given to it. Okay, so let's just discuss what is required rate. Required rate can be viewed as a hurdle rate, right? If say suppose, uh, if say suppose I have a required rate of 8%, and I have an expectation that equity share, Reliance Industries equity share is going to give me a return of 15% next year, and I have a required rate of 8%. Well, I'll be investing in that particular equity share. Obviously, yes. Right. My required rate is 8%. I have an expectation it will give me a return of 15%. I'll be investing in that asset. If I have an expectation that TCS, Tata Consultancy, is going to give me a return of 5% next year and I have a required rate of 8%. Will I be investing in that TCS equity share? No, because I have a required rate of return which is more than the expected return which the TCS is going to give me. So I won't be investing. Right. So this is basically required rate. Second being the discount rate. What is discount rate? So if you will see every asset class in this world, how do we get to intrinsic value of every asset class in this world? We just discount the future cash flows which are going to come from that particular asset, right? Say suppose you are a rich guy, government comes to you, says you give me 9500 today, and I'll return 10,000 after 1 year. So what is discount rate? Discount rate is basically 9500, 10,000 divided by 1 plus r. You are discounting this 10,000 by some required rate to get to this. So this is basically discount rate. 1 plus r is basically discount rate. All right. Moving ahead, opportunity cost. Opportunity cost is really easy to understand. I have two options today, right? I have 200,000. 100,000 in Indian terms is called lakhs, right? So I have, say, suppose 2 lakhs or 200,000. I have two options today. Either I can go to a trip to Europe, which will cost 200,000, or I can make a fixed deposit of 200,000, which will yield me an interest of 7%. And I'll be getting 14,000 as interest. If I chose to go to a trip to Europe, I'll be losing that 14,000 or 7% interest. So suppose I chose that, I went to a trip, then 7% or 14,000, the interest amount that I'm losing is opportunity cost. So yeah, interest rate can be viewed as three broad terms or three synonyms can be given to it, which is required rate of return, discount rate, and opportunity cost. I hope all three terms are clear to you. Now, moving ahead, what is determinants of interest rate? All right, determinants of interest rate. To explain determinants of interest rate, I need to take an example. Say suppose an Indian company, say suppose Adani Enterprises. Adani Enterprises wants some money and they didn't went to a bank. What they did is they came up to general public, individual investor, and to a particular individual investor, what they said is, give us 100,000 rupee and we will be paying you 13% interest on it. And after 10 years, we will return your capital amount to you back. Right? This is what Adani Enterprises came up with an offer. This is basically called bonds. Right? You are going to learn all these terms as we progress in the curriculum. So this is what Adani Enterprises come up with. So this 13%, the interest rate. How did Adani Enterprises come up with that 13% interest? This is basically what we are going to study in determinants of interest rate. Now 13% can have several of the factors. First being the real risk-free rate. What is real risk-free rate? Basically, I am postponing my consumption today. I could have invested that, I could have consumed that 100,000 today, and I won't be investing that 100,000 into Adani's bond for that long period of time. I could have consumed today. I could have purchased some commodities, some kind of service for me, and I could have enjoyed that service or product. But I chose to invest and I postponed my consumption. I've delayed my consumption, and for that, I need some kind of a compensation to it, right? This is basically real risk-free rate, a compensation to me because I have postponed my consumption today. That is real risk-free rate. So suppose real risk-free rate is 4%. Now, what is inflation premium? Inflation premium is simply money losing its power over time. 100,000 rupee value that it has today was a lot more. 30 years ago, you could have bought an entire house for 100,000 rupee 30 years ago, but now you are not able to pay your CFA fees also for 100,000 rupee, right? So money losing its power, it you loses its every year. It keeps on losing some value, right? Inflation, that is basically called inflation. So I need compensation to that as well. I have invested some amount. I have not consumed it. I need some compensation to that. I need some compensation to inflation as well because my money will lose power. You have taken my money and for the years being the bond is, and money will lose its power. So I need compensation to that as well. That is basically inflation premium. So suppose inflation premium is 3%. Money will lose 3% of its value every year. I need compensation to that. So this is basically 3%. Now, what is default risk premium? Default risk premium is what if Adani Enterprises fails to repay my principal or the interest amount that it has promised, right? I'm carrying that risk because everything can happen, right? Adani Enterprises could go into default, some business can go wrong, some policies can go wrong, right? Anything could have happened. I need some compensation to that. I am facing that risk. My capital can go at a default, right? It is possible that Adani Enterprises doesn't pay the interest back to me or the capital back to me. I am facing that risk, and because I am facing that risk, I need some compensation to it. So yeah, that is basically default risk premium. Now, default risk premium can broadly vary industry to industry, company to company, right? If there is a strong company with strong business model, right, then default risk premium can be lower. If there is a high risk company, then default risk premium can be much higher. So suppose in Adani Enterprises, default risk premium is 2%, right? Risk of default basically. Now, what is liquidity premium? Liquidity premium. If I am not able to sell off my asset at right valuation whenever I wish to, then I need some kind of a liquidity premium. Say suppose gold. Gold is a liquid asset. Whatever the rate, whatever the spot rate is today, I can go into the market, sell off my gold at correct valuation without any discount, whatever the spot rate is today, right? Gold is a liquid asset. But is real estate, a house, a property is a liquid asset? No, it is not a liquid asset. If you want to sell off your house, it will require some time, right? 2 months, 3 months, 4 months, around a year as well in some areas, right? You would not be able to sell off your real estate or your property or house at correct valuation instantly. If you want to sell it, you have to sell it at a discounted price. right? So this is basically compensation to liquidity. I need some compensation because I am not able to sell off my asset. What if I need some money? There's an urgency. I need some money, right? And I'm not able to sell off my asset at correct valuation. I have to sell it at a discounted price. So a compensation to liquidity is called liquidity premium. Might be possible that I am not able to sell Adani's bond at correct valuation whenever I need the money. So I need compensation to that. That is basically liquidity premium. So suppose liquidity premium is 7 to 9 to again 2%. Right. Now what is maturity premium? I have two options today. Either I can invest in an asset which has a lock-in period of 1 year, or I can invest in an asset which has a lock-in period of 20 years. Which one I should choose? Obviously, with an asset which an with I should go with an asset which have a lock-in period of 1 year, right? Because then after 1 year I am free to sell my asset, right? I am free to do whatever I want to do, other than just investing in a 20-year lock-in period asset. So because if the lock-in period is more, right, my money gets locked up for a longer period. I need a compensation to that. So that is basically maturity premium. So this is how we get to the 13% interest rate. In this case, Adani Enterprises issued a bond of 10 years. So for 10 years, your amount will get blocked, right? So you need some compensation to that. So what is the total as of now? 4 plus 3, 7, 7 plus 2, 9, 9 plus 2, 11, 11 plus 2, 13. Okay. So say maturity premium is also 2%. All right. So this is how we get to interest rate of a corporate bond and all. You will get to learn everything as the program progresses. So now nominal risk-free rate is very simple. It's just real risk-free rate plus inflation premium. Every number that is quoted by government agencies, by banks and all, it's everything is in nominal rate, right? It's real rate plus inflation premium. Now return measurement over time. How do we measure the return? Holding period return is the simplest one. Say suppose I have bought a house for 1 million, right? And I holded that asset, that house for 3 years, and after 3 years I sold it for 1.4 million. So zero point 0.4 million is the gain amount. 0.4 million I gained over a 3 year period. I holded that asset, that house for 3 years, and I zero point 0.4 million I gained in that 3 years. So 40% I gained. So 40% is the holding period return over the 3 years. Basically simple. Whatever your holding period is, whatever the period that you are holding in, right? You have to take into account that period and the return that you have generated. The return that you have generated, you will take into the account of capital gain as well as the recurring income in that. Say suppose I have put that asset on rent as well. Okay, I have bought a house wherein capital gain is also there, and I'm getting the rental yield as well, right? So I will consider the rental yield as well and the capital gain as well, and I won't annualize it, right? So this is basically holding period return. We'll understand it. We'll take an example of it. So that is holding period return. You will be considering income yield and capital gain as well. Arithmetic mean is simple, average, nothing complicated. Everyone has learned in the school. 5 plus 10 plus 15 divide by 3. Simple. 5 plus 10 plus 15. This is your data set. Divide by 3. Right. 15 plus 15, 30 divide by 3 is 10. This is your simple average. This is called arithmetic mean. Geometric mean is basically CAGR, compounded annual growth rate. You are going to learn this. We'll take a lot of examples and you'll understand this as well. CAGR. Harmonic mean is used when we are averaging out ratios. Okay. All right. When we are playing with the ratios, like how do we average out the P ratios? Say suppose price to earning multiple and all. We'll understand it I know it gets difficult if I just throw all of these terms all of a sudden. So harmonic mean we'll study as a program process. It is used when we are averaging out the ratios or cost per share and all. This is used harmonic mean. This is when harmonic mean is used. Trimmed mean and vinsorized mean. So now let's move ahead to trimmed mean and vinsorized mean. What is trimmed mean and vinsorized mean? So whenever you have an outlier in the data, we use trimmed mean and vinsorized mean. Say suppose now the data is 5, 10, 15, 20 and 2000. Now if you will calculate the simple average, which is arithmetic mean, the average with that will you will get will get biased because of this 2000 value. So what we can do is we can use trimmed mean or vinsorized mean, wherein what will happen in a trimmed mean, you will just calculate a simple average wherein you will just remove the 2000 value. How will you calculate the trimmed mean? Just a minute. What you will do in trimmed mean is 5 plus 10 plus 15 plus 20 divided by 4. In simple average, in arithmetic mean, what we have done is 5 plus 10 plus 15 plus 20 plus 2000 divided by 5. And trimmed mean, what you will do is 5 plus 10 plus 15 plus 20 divided by 4. You will just eliminate the 2000 value. In vinsorized mean, what you will do in vinsorized mean, you will replace the 2000 with the closest value, right? So what you will do in this vinsorized mean is 5 plus 10 plus 15 plus 20 plus 20. You will replace 2000 with the closest value plus 20 divided by 5. This is what you will do in vinsorized mean. You will just replace the outlier with the closest value possible. So this is vinsorized mean. Okay, so now let's move ahead. Portfolio performance measure. How do we calculate the portfolio's performance? So money weighted return and time weighted return. Money weighted return and time weighted return. So you have to basically understand the timing of the cash flows are very important when you are considering investing in the equity markets or stock markets. Timing is very important. If you invested some money just before the bull run started, you will make enormous amount of return. And if you have invested some money just before the crash, right, or the bear run, then you will definitely lose some amount of money. So if you have control over the money, when do you want to invest, when do you want to withdraw the money, then we will calculate the money weighted return. Money weighted return for the portfolio's performance, right? So suppose if the portfolio manager has the control over when does he want to invest that money or when does he want to withdraw that money, then we'll calculate the performance of the portfolio manager by money weighted return. And when he doesn't have control over the timings of the cash flow, like you are controlling the timings of the cash flow, right? So then he doesn't have the control over the money, right? So when he can invest or when he can withdraw, he doesn't have a control. He can just select the stocks, right? So you just have to judge him on the basis of the quality of the stocks selected. Then we calculate the time weighted return of the portfolio. So it doesn't take into the account of timings of the cash flow. So in general, when we are investing in a open-ended mutual fund wherein you are having the complete control over the money that you are investing in, right? When you want to invest, when you want to withdraw, you can uh, we calculate the time weighted return in that period, in that particular asset. And say suppose hedge funds and all, where you do not have a complete control, right? Where do you want to, when you want to invest or when you want to withdraw, portfolio manager has that control. Then we calculate the money weighted return. So right, we'll discuss it further. Other return concepts, annualized return. So sometimes what really happens is in some instruments, say suppose you go to a bank and your relationship manager or some of the sales guy over there and says come to you and says we are having an insurance policy or some kind of a instrument which will yield you an interest of Say suppose 14% over 1.5 years, over 1.5 years, compounded. Now it is difficult to compare, right? You need to annualize the things up, right? So this is what we are going to study in other return concepts, annualization of returns. Gross versus net return, when you take into the account of the management fees, taxes, charges, trading costs and all. So if you don't take into the account, then it is gross return. If you take into the account, then it is net return. Pre-tax versus post-tax, if you take into the account of taxes that you are going to pay to the government over the capital gain, over the dividends received, over the interest received, right? If you are taking into the account, then it is post-tax. If you are not taking into the account, then it is pre-tax. Normal versus real return, if you take into the account inflation, right, the money losing its power, inflation, if you are taking into the account inflation, then you are basically considering nominal return. If you are deducting the inflation part, then it is real return. Leverage return, if you are borrowing money and investing that money in your portfolio, like suppose if you took a personal loan and you invested that amount into your own portfolio of stocks, then you are basically taking leverage. So leverage return and unlevered return, normal return, we are going to study that as well. Leverage can have a great impact on your portfolio. So if you borrowed the money just before the bull run and you invested in your particular portfolio, then you can amplify your return. And if you borrowed the money and you invested in your portfolio and then the market crashed, then you could get in a big trouble. So this is just an overview of the chapter. Now we are going to study each of the topic in detail. Okay, so thank you. Now we are going to study this in next lecture. We are going to start second LOS, interest rates and time value of money, in next lecture. Thank you.